So you're doing a documentary on the Fed and monetary policy?
We are trying to.
Okay.
Are we insane?
No. I think it's a great idea.
Okay.
Joseph Stiglitz is one of the most well-known economists in America and a winner of the Nobel Prize.
The intention of the Fed was to stimulate aggregate demand.
He told me that while the Fed had done some good, he worried at the time that by stoking the stock market so aggressively, it was exacerbating economic inequality.
The main thing I was concerned about was that the way they were trying to revive the economy was a kind of trickle-down economics. The way quantitative easing works is that it's a lowering of the interest rates that leads stocks to go up. And so who owns the stocks? It's the people in the top, not just the top 10%, 1%, 1/10 of 1%. And so it increases enormously wealth inequality. We had increasing inequality really since the late 70s, and this was putting that on steroids.
What sort of response did you get from folks at the Fed to what you were saying at the time?
Our mandate is to do what we can to increase employment, to use the tools that we have, and that's what we're doing.
I heard a similar response when I raised these issues with the president of the Minneapolis Fed, Neel Kashkari, in March of 2021. He was the only current Fed official who agreed to speak to us.
The Fed has been on a mission, I've been on a mission, to put Americans back to work and help them get their wages up, especially for those lowest income Americans. And if it has had some effect on Wall Street, to me, the trade-off is well worth it if we can put Americans back to work so that they can put food on the table, they can take care of themselves. That is profoundly beneficial to society.
One of the things that we have seen in this country is a widening wealth gap. The question is, what role, if any, the Fed has played in widening that wealth gap?
Well, this is a great point, and I'm glad you raised it. Most people who make this argument ignore the fact that for many Americans, they don't own a house, they don't own stocks, they don't have a 401k. The most valuable asset they have is their job. So by putting people back to work and helping to boost their wages, we are actually making their most valuable asset more valuable.
Middle-class economics works.
President Obama today in Wisconsin fired up over jobs. Another 223,000 added in June.
In fact, by 2015, the employment numbers were improving dramatically. But critics I spoke to said the Fed's focus on jobs was missing the full picture.
I mean, Neel Kashkari told me that a job is a great asset. That when
his may be. I'm not so sure that's true for the folks working 3 jobs behind the counter at the supermarket. Sorry, Neil, I think that is an elitist assumption of what labor income is good for.
Karen Petru is an unlikely critic of the central bank.
We've got Pete here.
Go on down.
She spent her career inside the financial system,
Down.
advising banks and big investors.
There we go.
Interview with Karen, take 5 marker.
2015 to 2020 was actually considered a time of recovery. Unemployment was getting to record lows, and there was a kind of conventional wisdom that the economy was in a good place at that point in time. So you disagreed with that?
I did, because most Americans disagreed with that. The majority of Americans said they were economically anxious. Significant percentages of people who were in the statistical middle class were skipping medical treatments because they didn't think they could afford them. 40% of the United States didn't have $400 in a rainy day fund, and they were at risk of imminent financial peril if a tire blew. That's not a good place.
What about this idea that there was record unemployment?
Record unemployment was judged the way conventionally the Fed chooses to judge it, not by taking into account the people sitting out working because they couldn't get enough wages with their jobs to make going to work pay. Employment was fine, so by at least some numbers, wages weren't. And people work to eat. They don't work because of some, noble ideal.
So just to understand, what was wrong with the models that the Fed was using in order to judge the success of their programs?
Paul Krugman, a well-known economist, has a great example. You've got 4 guys in a bar, each one of whom is making $60,000 a year. Jeff Bezos walks into the bar, and he's making $2 gazillion. Does that mean that the 4 guys in the bar are doing any better? No, it doesn't. It's distorting statistics. You have to look at how much each person has, not at what the averages are, to understand what's going on in the economy. And when 4 out of 5 guys in the bar are not doing well, the country isn't doing well.
The growing sense that the system was not working for the poor and middle class became a central theme of Donald Trump's populist campaign.
Sadly, the American dream is dead.
When you have a society with the middle struggling and the rich realizing like almost unimaginable gains, it starts to corrode the civic foundation.
We have to clean up the country. Our country is a mess.
People start to feel like this cliche you hear all the time, that the system is rigged.
Like he says, I think the system is rigged.
You know what?
He's just speaking what we're all thinking, but he's saying in the public domain, he's saying in the political domain.
You know, the fact that a huge portion of Americans were willing to vote for a president like Donald Trump, whose like entire campaign seemed to be burning down the system.
We are going to drain the swamp.
That doesn't just happen in a vacuum.
We are going to fix our inner cities and rebuild our highways, bridges, tunnels, airports, schools, hospitals.
It was a moment of potential for the Fed's easy money policies. Trump promised to take advantage of the low interest rates and create jobs by investing in new infrastructure.
We will create millions of new jobs and make millions of American dreams come true.
But once in office, the political paralysis in Washington only intensified.
Congress simply hasn't been willing to find the amount of money necessary to do it.
Making big economic investments all but impossible.
There just wasn't the political cohesion to push through these major programs. And you saw a lot of op-eds by a lot of economists and even Fed bankers themselves after the first or second or certainly third and fourth round of quantitative easing. They were saying, please give us some fiscal policy, meaning give us some government action to direct this money to the right places. We can't do all this alone. We can keep rates low. We're trying to keep rates low here, trying to keep confidence high, but we can't make you spend on a bridge or revamp a school.
Are you saying that there was sort of a squandered opportunity here?
100%. It was a missed opportunity. We didn't use the cheapest money in memory. I don't want to say in history, but certainly in the last, several decades. We didn't use that opportunity to spend on the things that would have been almost free in terms of debt. We really missed something that now will be more costly because now that interest rates are going up, I still think, for example, we should do more infrastructure spending, that we should revamp education, but it's going to be more costly to do it now.
It's the largest, I always say the most massive, but it's the largest tax cut in the history of our country, and reform, but tax cut.
The marquee legislative achievement to the Trump administration would instead be a tax cut that further boosted the markets and deepened economic inequality.
That's your bill.
The jury is still out on whether it contributed to the economic growth that had started to tick up during the Trump presidency. But to some inside the Fed, it seemed like an ideal time to pull back on the easy money experiment. One of them was Jerome Powell.
It is my pleasure and my honor to announce my nomination of Jerome Powell to be the next chairman of the Federal Reserve. Congratulations, Jay.
Thank you, Mr. President.
Trump appointed Powell in late 2017.
Jay Powell is a profoundly competent, smart guy who has spent his entire career at the nexus of big money and big government.
In the years since the global financial crisis ended, our economy has made substantial progress toward full recovery.
Self-acknowledged Republican, he's a conservative. He tends to embrace the deregulatory view of the economy, and he's also a Wall Street guy who came up through the business of corporate debt and deal making.
The Fed is seen continuing to raise interest rates going forward, and I think they can.
The Fed had already begun raising rates and reversing QE. They'd call it quantitative tightening, or QT. Powell took office eager to accelerate the effort.
The really extraordinarily accommodative low interest rates that we needed when the economy was quite weak, we don't need those anymore. They're not appropriate anymore.
Once again, the market threw a tantrum.
The Dow closing down more than 500 points today.
A brutal week in the market. The Dow and the S&P now on track for their worst December since the Great Depression.
The global financial system short circuits.
The decline will accelerate if Jay Powell doesn't walk things back.
The president threw a tantrum too.
I think the Fed has gone crazy. It's a correction that I think is caused by the Federal Reserve.
If the Fed knew what it was doing, they would lower rates and they would stop quantitative tightening.
The president has been attacking the Fed chair on Twitter very often for raising interest rates.
With the Fed's decision to raise interest rates, he suggested it would hurt the economy.
Tweety said quantitative tightening was a killer, should have done the exact opposite.
Powell would change course.
The Federal Reserve cut a key short-term interest rate today after raising it as recently as December.
You see this complete reversal and what a lot of investors and economists saw as a capitulation to financial markets. Financial markets don't like this, so the Fed's going to reverse course. And that has defined Chair Powell ever since then.
A tricky balancing act for Chairman Powell. He'll now face criticism that the Fed has bowed to pressure from the White House, or Wall Street, or both, sacrificing the central bank's precious independence.
The Fed blinked, and the Fed reversed course when the market was down sort of 20% and went from tightening policy to easing policy. And it became very clear to the market that saving the stock market was now one of the Fed mandates. And I think that had really ominous ramifications for the future.
By 2019, the Fed's easy money experiment had been going on for a decade.
The Fed's job isn't to help the President of the United States, it's to do its...
What had started out as an emergency measure to save the economy had become the status quo.
Yes, quantitative easing is there, but it's a tool you don't want to overdo.
And it was deepening the concerns about how the Fed was fueling troubling trends. Taking advantage of the Fed's low rates, private equity firms had been buying up huge swaths of the economy with borrowed money.
110,000, 128,000.
For multi-billion-dollar private equity firms, this is a bargain hunt.
Concentrating wealth and ownership of everything from houses to hospitals.
Across Blackstone, we own a range of things. So SeaWorld, Busch Gardens, Bird's Eye Foods, Michael's Stores, Hilton, and Waldorf. What we like to do is come in, buy either real estate or companies. We see an opportunity to grow something faster, to invest capital, fix whatever that is broken, and then sell it.
The Fed's policies had also been fueling a frenzy in Silicon Valley.
WeWork has announced it's received a massive $4.4 billion investment from SoftBank Group,
leading to all sorts of excesses.
Venture capitalists pumped nearly $500 million into the food delivery startup industry.
Airbnb is now valued at $10 billion, more than big hotel chains including Hyatt and Wyndham.
And enabling certain tech companies to disrupt and dominate entire industries without ever turning a profit.
WeWork is saying its total opportunity is $3 trillion. I mean, that's 3.5% of the entire world's GDP.
But perhaps the most destabilizing consequence to the economy was how the Fed's low interest rates had been incentivizing public companies to take on more and more debt.
Valuations are generally elevated, especially corporate debt.
We have flagged the rise in corporate debt.
We have entirely too much corporate debt out there. And
I saw numerous studies and reports detailing the extent of the debt and how even marquee companies were becoming so leveraged their credit ratings plummeted. The Fed had hoped that companies would put all that borrowed money to good use and invest in their workforce and their infrastructure. But in reality, it played out differently.
Buybacks.
Buying back stock.
Stock buybacks. Stock buybacks, robbing the American worker.
Companies were often borrowing money to buy back their own stock, making the remaining shares more valuable and the prices higher.
As a corporation, you realize all that matters is the stock price. So what do we have to do to increase the stock price? And more often that is buying back the stock. So it used to be the Fed would lower interest rates, businesses would then take on more debt, they would use that debt to hire more workers, build more machines and more factories. Now what happens is the Federal Reserve lowers interest rates, businesses use that to go out and borrow more money, but they use that money to buy back stock and invest in technology that will eliminate workers and reduce employee headcounts. They use that money to give the CEO and other corporate officers big bonuses, and then eventually issue more debt and buy back more stock. So it's this endless cycle of things that are designed to increase the stock price rather than improve the actual company.
Okay, GE just authorized a $50 billion stock buyback.
The numbers were astounding. More than $6 trillion in corporate buybacks during this easy money decade after the financial crisis.
$50 billion stock buyback. That makes a big deal, big difference to the stock price.
Buybacks were an embarrassment. And so it's just another example of things that used to be viewed as kind of, just going mainstream.
Sheila Bair, a former top banking regulator, was issuing public warnings at the time that the Fed was incentivizing bad behavior on Wall Street despite its best intentions.
I can't fault the company so much because this interest rate environment creates very strong economic incentives to do exactly what they're doing. It's hard to create a new product. It's hard to come up with a new idea for a service. It's hard to build a plant and hire people and run the organization. It's real easy to issue some debt and pay it out to your shareholders to goose your share price. That's real easy to do, but it doesn't create real wealth. It doesn't create real opportunity. It doesn't create jobs. It doesn't improve the labor market. But it's just another example of how these very low interest rates have really distorted economic activity and frankly been a drag on our economic growth, not a benefit.
Warren Buffett likes Apple's buybacks.
Well, why wouldn't he? He's a shareholder and you're buying back $100 billion in stock.
When you get an age of easy money like what we've seen, you get a financialized economy that's really more in service to itself. So most of what it's doing is buying and selling existing assets rather than helping real businesses and real people make real investments. But one of the things that's so diabolical, I would say, about easy money and our financialized economy in general is that we're all in it. We're all part of this Faustian bargain of pretending that there's something wonderful happening in the real economy when really it's just Wall Street going up. But we all kind of want the market to go up because we're in it with our pension funds and with our 401ks. So everybody's money is kind of helping to push this whole cycle along.
Even some of the largest beneficiaries of this trend told me it made them uncomfortable, like legendary investor Jeremy Grantham.
In my career in America, the percentage of GDP that goes to finance has gone from 3.5 to 8.5. In a way, we're like a giant bloodsucker, and we have more than doubled in size and sucking more than twice the blood out of the rest of the economy. And we do not generate any widgets. We do not generate any real increase in income. We are just a cost.
When you say we, you mean you and other members of the financial community have been this kind of bloodsucker on the economy? Is that what you're saying?
Yes, collectively, we fulfill a completely necessary service. But what we have done is created layers upon layers of more and more convoluted, expensive financial instruments. And that's what makes all the profits for the financial industry. And it's taken a lot of ingenuity and salesmanship to make this happen, and a lot of lobbying in Congress, et cetera, et cetera. And we have imposed on the rest of the economy the idea that banking and finance are utterly important at all times. If you do anything wrong to us, the entire economy will collapse in ragged disarray.
corporate buybacks, the elevation of corporate debt. Well, how is that viewed by you and others at the Fed?
Something we pay a lot of attention to, but when companies are buying back their stock, one of the things they're telling us is we don't have profitable places to invest, and it's easier for us just to buy back our stock. That's concerning in terms of the future of our economy, but that's not because of the Fed. So we pay attention to it. It really matters. But in my view, it's not something we control.
Kashkari and others have pointed out that it's the job of Congress and regulators to address some of these concerning trends. And when we sat down in 2021, he was quick to dispute the criticism that the Fed's policies had really just been boosting financial markets and helping Wall Street. We hear it all the time from Wall Street people that basically that prices are completely untethered from some fundamental reality. There is this idea on Wall Street that the Fed kind of has our back, and that because you may have well-intentioned policies that are trying to get everybody to work, there is this side effect, this unintended side effect of just kind of really helping the rich.
That argument ignores the benefit to the poor. And if you're going to ignore the benefit to the poor, then we're only helping the rich. But of course, that's an incomplete analysis. When you actually sit down and say, well, let's go through the trade-offs of the choices that the Fed has, whether it's interest rates or it's quantitative easing, it's not just about Wall Street. It's not just about asset prices. It's also about thinking about the men and women in America who are trying to find work and who want to have higher earnings and who deserve higher earnings. If we are benefiting them by helping them find work and helping them have higher wages, I will take that trade-off.